So hello friends, good morning to all of you, and today this is the first mega session related to the CAIIB BFM, and we are going to basically take these classes in English only language. So if you're preparing for CAIIB 2024, you must be watching the complete series of BFM ABM live sessions because we are going to cover each and everything related to the CAIIB BFM. We will be covering the questions, we'll be covering the case studies, we will be covering the all important concepts related to the same. But before starting the session, do confirm the audio video quality so that we can start the session over here. And further, if you have been following the learning sessions for a while but you have not subscribed so far, considering subscribing to the channel and also press the bell notification icon so that you get updated whenever we upload the new videos. So we are going to start with the module B of the BFM, that is a bank financial management, because module A and module B are the most important modules in the era of BFM CAIIB. And even if you cover these two modules, you can definitely be clearing the CAIIB BFM in the very first attempt. So that would be related to the syllabus priority of this particular BFM also. So you need to follow the syllabus priority of BFM, as first of all you need to cover the module B, then you should be covering the module A, then after that cover the module C, then module D. Somewhat part of the module D is already covered in the module B over there, so you can basically be keeping it a particular part that you can be covering it at the last point over there. And let me just tell you one thing, that if you want to get the PDF of these particular sessions on daily basis, you just need to join our WhatsApp group. Simply do WhatsApp us writing CAIIB. So what do you need to write? I'm just mentioning it on the chat box over there. You just need to write CAIIB, and further you need to WhatsApp this particular CAIIB to the number 83609 44207, right? So you need to write CAIIB and further WhatsApp it to the number 83609 44207. I have already pinned this particular message in the chat box over there, so you can considering messaging on this particular number, and we'll be adding you to the appropriate group of CAIIB, and you will be able to basically get access of all the PDFs files over there. Whatsoever the live sessions will be there, you'll be able to get the access of the same. So now, without wasting any time, let's jump to the main session, and further we are going to start with the first chapter of the module. Particularly, we are having the module B over here, and it's actually related to risk and the basic risk management. Why this chapter is very much important, just let me tell you one thing, that what is actually risk, because risk is related to the second module only, right? So even if we are talking about, so if we are talking about that we are to cover the chapter related to the module B, it's basically based upon all risk. Now what is the basic definition of risk? Risk is actually the possibility of loss, right, due to the uncertainty. Definitely in the different markets, in the various markets, whether we are talking about the money market, capital market, or any of the markets, there is uncertainty. Even if the bank is sanctioning the loan, there is uncertainty if the bank will be receiving back their money or not. There are different kind of risk. It is a credit risk, market risk, operational risk, liquidity risk, interest rate risk, price risk, etc, etc, etc. The list goes on, and we should be answering that. We should be knowing why learning these particular list risks is very much important, right? Now, not just let me tell you one thing, if there is more uncertainty, then there are more cash flows associated with the same. What does this indicate? This particularly indicates, let's say case that you made an investment in FDR, and further you are receiving an interest at 8% per annum over there, right? Now it's quite a very low return, let's say you are getting. And further, let's say you also invested money in mutual fund, right? And over there you're getting 14% per annum. Which one would be much more helpful to you? No, which is basically giving you an idea that the more risk will be associated over there. Definitely it basically indicates that there is more risk there in the mutual funds. Now what does it indicate? It particularly indicates more is the risk associated. So we simply can say, if more is a risk associated over there, more will be the returns. Then there will be more returns in that particular scenario, right? So that's the concept over here. Second most important thing, the first important thing was related to more is the risk, more would be the return over there. The second important thing, it's related to more is the risk, more is the capital required so as to absorb the losses. Why do you require the extra capital with you? Because you want to absorb the losses over there, right? That's why it's particularly being required that particularly you should be having extra capital with you guys, right? So that's the main funda related to. So more is a risk, more is a return that you are expecting to get over there, and more is the risk, more must be the capital that you must be having with you so that you can absorb the losses from those particular risks over there. And very important announcement for you all guys who are preparing for CIIB, these live sessions will be there free of cost for each and everyone who is following us on the YouTube. But also let me just tell you that these live sessions will not be there forever. Like these sessions will be removed after 24 hours. Only the first session will be retained, and after that no sessions will be retained on the YouTube, and the classes will be removed after 24 hours we have streamed the video, right? Now, let me just give you one more idea. It's related to more is the capital that you basically require, and further more is the risk. More is the risk. More is a variability. More variability you will be having. Variability means, let's say previously the variability was not there. In case of FDR, let's consider there is no variability of the cash inflow. So whatsoever the cash inflows, whatsoever the amounts of the interest that you have been receiving during the particular tenor of this particular FDR, that will be quite fixed. Let's say you are earning, let's say 8,000 rupees per month or something like that. That's a fixed amount over there, but that won't be fixed in those particular instrument where you're having more risks involved over there, right? Now that's the main funda related to it. So more is a certain uncertainty associated, that was the main part. More is the capital required by you, that is the main part. And further, let me just tell you, higher risk would imply what? It will imply that it will be having higher upside and downside potential. That if you will be getting profits, it may be like that you can be earning rupees 100 from rupees 100, and further if you're basically having the losses, in that scenario you will be having the higher losses also. That is the main funda related to the thing, that you will be having higher upside as well as the higher downside potentials associated with it. So I have already conveyed the idea to you that what is the relationship between the risk, capital and the return. So more is a risk, more is a capital required, and more is a return that you are expecting out of it. That's the main funda related to it, right? So more would be the variability. Variability is basically related to more is the variance. So when the risk factor is higher, the variance is higher, the variability of the inflows is higher. That's the main funda related to it. I have already conveyed that particular idea to you, right? So you can simply be reading the point over here, that capital requirements would also be lowered because of possibility of low risk. So when you're having the lower losses, definitely the lower risk is there, and when you're having the lower risk over there, indefinitely in that scenario you will be having the lower capital requirements also, right? That's the main thing related to it. Now there is a concept related to RAROC. Now what is RAROC? One, we are having the return on equity. One definition that I want to basically convey is return on equity or return on capital or return on capital. Now what do you mean by return on capital? Let's take the case that I invested rupees 10,000. Let's take the case that I invested rupees 10,000. Now that is particularly I have invested the amount, and let's say I have earned rupees 1,000 upon that, right? So that is what, that is a return on capital would be equal to rupees 1,000, and further employed capital was 10,000, so it will be 10%. So it will be 10% over there. Now consider the factor, have we considered the risks when we are considering this particular output over there? No, we are not considering any kind of output over here. Is that clear? So we are not considering any kind of risk. No risk is being considered in this particular part, right? We are not considering the risk over here. That's the main funda. But in case of RAROC, that is a risk adjusted return on capital, you also basically you also consider the risk factor. What does it indicate? It indicates, let's say I'm saying that I'm having the returns without considering the risk equal to 8%, and let's say I'm saying I'm having the RAROC of 7%. Now which is more appropriate to me and which will be more meaningful to me? Definitely the second one, that is a 7%, that is the RAROC, will be more meaningful to me, because I already know now that even if the risk is there, this much return I'm going to get over there. That is a risk adjusted return on capital. So whensoever the decision is to be made where the capital is to be deployed, you must be considering the factor related to the risk adjusted return on capital, then just be considering the return on the capital employed over there, right? That's the basic main idea behind the thing I want to tell you, right? So risk adjusted return on capital is basically the key factor when you have to make any decision related to the same. And further, as I told you, that return on equity that basically fails to capture the risk associated with the same. So you should not be considering the return on equity only, but you should be considering the risk adjusted return on capital over there, right? So that's the main funda. Now let's consider the example over here. So we are actually having a firm that wants to invest rupees 1 lakh. So that firm basically want to invest rupees 1 lakh over there, and they're having, let's say, two options. One investment one, and the other one is investment two. And in the case of investment one, they're getting 8,000 returns each and every year. For the 5 years, they're getting 8,000 of the returns, and in total, they got 40,000 rupees. So that's the funda. And further, in the investment two, there is variability of the inflows. Like in the first year, we got 7,000, then 5,000, 14,000, 6,000, and 12,000. In total, we get 44,000. In total, we got 44,000. Now the question is over here, it says if the time value of money is not taken into account, if the time value of the money is not taken into account, the rate of return of the investment will be. Now time value of money says what, that today the value is something more, and further later on the value will be lesser. Let's say if you're having rupees 10 lakh in your hand right now, let me just draw a timeline over here, right? So if I'm having representing this as the present time, that is 0, then for the 1, 2 and 3 and 4 and 5, let's say if you're having 10 lakh rupees from 5 years from now, in that scenario it will be valuing more, or 10 lakh rupees if you're having today in your hand, that will be valuing more. Definitely, if you're having 10 lakh rupees in your hand right now today, that will be valuing much more, right? So that's the main funda, that's the main funda over there, and you should be considering the main factor over there, right? So that's the thing. And further, if you're not considering the time value of money, in that scenario, what will be the return in the investment one? It will be equal to 40,000 divided by, because you are getting 40,000, and further divide by 5 years, so it will be equal to 8%. So 8% is the return that you're getting when we are not considering the time value of money. And in the second scenario, it will be equal to 44,000 divide by 5, so it will be equal to what? Let me just use a simple calculator, it's quite easier. It's 8 point, it's 8 point what, 44,000 divide by 5, that will be equal to 8.8%, right? So it will be 8.8% over there, because we invested rupees 1 lakh, because we invested rupees 1 lakh over there. So it is 8.8% in the second scenario. Is that clear? Is that clear? Is that particular part clear to you? Right? Now let's have a look at the second question over there. It says if risk adjusted rate of return is assumed to be same in both the cases, which one will be preferred? Now, it is particularly saying that if we consider that RAROC, that is risk adjusted return on capital, is same in both the cases. Let's say we are considering it to be 6.75% in both the scenarios. We're just assuming it, right? In that case, what investment you will be preferring? Kindly do answer at the earliest. So if I'm saying, I just told you the concept related to risk adjusted return on capital, that we consider the risk factor also. Now we're basically saying that if we consider that the RAROC is all same in this scenario, that the RAROC is all same in this scenario. Now in that scenario, what thing you'll be considering? What investment you'll be considering as the best option with you? Just kindly do answer over here at the earliest. Kindly do answer over here at the earliest that what investment will fit best for your portfolio. Now see, in the investment one, as I told you, there is no variability of income. There is no variability. Definitely it's a better choice. Then in case of the investment two, that is, there is variability of income. There is variability of income in the case of investment two. So definitely I won't be going with the investment two. I'll be going with the investment one, because I'm not having the variability of income in that scenario. Is that clear? Is that particular part clear over here? So if you have liked the video so far, if you have liked the content so far, kindly please give this video a thumbs up. And further, if you are having any query related to BFM, you can post the same too. You can post the same too. If you're having any kind of doubts also, kindly do post the same, right? So now let's move further towards the basic risk management framework. Now what do you mean by risk management framework? Now whenever we are talking about the risks over there, It's just related to, first of all, we need to identify the risk. Whensoever we are talking about the risk factors over there, the first thing it's related to identify the risk. Whensoever we have identified the risk, after that we need to quantify the risk, that is to measure the risk over there. So the first point, it's always related to identifying the risk, that whatsoever the kinds of different type of risk which is particularly in our portfolio. Then we need to quantify that, we need to measure the quantity of the risk over there. And after that we will be going for what, we'll be going for the monitoring and control, that how we can be monitoring those particular risks, how we can be controlling those particular risks over there. And last but not the least, it's actually related to the mitigation. It's related to the mitigation. Yes, sir, this is a live session. It's a live session, sir. It's not related to, it's not a recorded session, it's a live session. And there will be live classes on daily basis. In the morning, you'll be able to watch the sessions at 6:45 a.m. onwards. On daily basis, the classes will be there, right? So that is the main process that we need to follow. That first process, it's related to the identification. The second one, it's related to the quantification. The third one is related to the monitoring and control. And the fourth one, it's related to the mitigation of the risks over there. That's the main funda, and that's a basic management framework for the same over there, right? Now, let me just tell you that you want to manage the risk. Why do we want to basically manage the risk? So that we can analyze that what amount of capital is to be maintained. Now see, the regulators are there. Regulator, like we are having the Reserve Bank of India. In India, we are having the RBI. And on international level, we are having the BCBS, that is Basel Committee on Banking Supervision. Now, BCBS particularly gave the Basel guidelines. Basel guidelines were given by the BCBS, right? And it's basically related to recommending the supervisors of the different countries related to that, what capital is to be maintained, what are the different guidelines or standards for the same, so that there is no apocalypse in the economy, right? So that's the main funda related to it, right? Now in that scenario, the RBI has prescribed that if you are taking such risk over there or any kind of risk over there, in that scenario you are also to basically maintain the risk capital for the same, so that if there is any losses, right, you should be able to absorb such losses. You should be able to absorb such losses. So risk management is very much important if you basically want to limit the capital that is to be maintained. Because let's say the bank is having 100 crore rupees of the deposits, bank are to pay the rate of interest to the depositors also. Now if they will be basically just retaining the capital for the risk purposes, in that scenario that will be total loss to them, right? So that's basically required over there, right? And further, it's related to identification and quantification. It's very much required. You must be identifying that what different risks are there in your portfolio, so that you can be reducing to the level that is as per your appetite, right? So it's not basically possible so as to mitigate the risk at all. Like we cannot be going for the zero risk policy at all. We should be looking for the areas that how we can be avoiding the risk, not avoiding the risk, that how we can be reducing the risk, that how we can be reducing the risk. But it's not related to that we can be totally let's say totally we cannot be making the risk zero over there. It's not possible at all over there, right? Is that clear? Is this particular part clear over there, right? Now after that it's related to pricing of the transaction. Now why we basically want to measure the risk? Because we want to price the transaction. Let's say case, if the bank is lending a credit card, the interest rate will be much more rather than the bank is lending the housing loan. Because in case of housing loan, the loan is quite some secured over there, right? So bank won't be charging that much. So pricing is to be done. That's why also it's basically requires that you should be measuring the risk which is particularly present in a product line over there, right? So that's also required over there. And for managing the risk, you do require the personnel which are having the special skills, and they are having an objective that they want to basically reduce the risk to the appetite level over there, right? So that's the thing. Now let's have a look at the organization for the risk management. So first of all, we are having the board of directors. The board of directors are having the ultimate responsibility related to managing the risk over there, so as to articulate the policy and for the approval of the risk management policies over there. So everything is to be done by the board of directors. So everything particularly that's related to auditing systems, that's related to reporting systems, that's related to managing and further deciding the limits and approval, not deciding the limits but for the approval of the limits, that those all things are to be done by the board of directors over there. So that's the main role of the board of directors. And after that we are having the RMC. RMC is basically board level committee for the risk management. It's a board level committee for the risk management, so we can say it's a board level subcommittee over there. So whatsoever the guidelines there are there which are to be set up, any potential limits which are to be set up, that let's say we want such kind of limits for our risk over there, and further if you want to check the robustness of the system over there, and further so as to have a proper manpower in the system over there, these all duties are with the RMC, that is a risk management committee at the board of directors level, right? And the third tier, it's related to the committee of the senior executives. Now whatsoever the senior executives from the different functional departments, they will be forming a committee so that they can be giving their inputs into the same, they can be giving their inputs, they can be giving their feedback, and further they can be looking into the different things over there, and also they are to implement those policies which are being developed and approved by the board of directors, right? So that is to be done, and that is to be done simultaneously, like whatsoever the risk management committee policies are there, those are to be implemented, and along with that the organizational objectives are also to be achieved. So those all things are to be done over there. And further after that we are having the risk management support group. Risk management support group, now it's basically the ground workers, it's related to the ground workers who will be analyzing the things, who will be monitoring the things, who will be basically reporting the risk profile to the senior management over there, and also they will be working independently. Also they have to work independently over there, that's the main thing. So first of all we are having the board of directors, and after that we are having the risk management committee at the board level, we are having the senior level executive committee over there, and on the last we are having the risk management support group. We are having the risk management support group. So these are the 4 tiers which actually do the organizational hierarchy for the risk management over there. Now, as I've told you, the process for the risk management, it's quite easier to understand. First of all, it's related to the risk identification, that we should be identifying the risk over there. The second one, it's related to the risk measurement and the quantification over there. The third one, it's related to risk pricing over there. When fourth one, it's related to risk monitoring and control. Then the last one, it's related to the risk mitigation. So let's start with the risk identification, that how we are going to identifying the risk over there. Now, what are the transactions that you are going to undertake as a banker? Those must be having the risks associated with them. Those must be having the different types of risks associated with them. It could be, as I told you, it could be related to the interest rate risk, it could be related to market risk, it could be related to credit risk, operational risk, and so on, right? And further, these risks are interdependent. These are also independent. These are also interdependent. Such risks, some kind of risks which can be easily be identified and quantified, and some risks are not that much easier to be quantified over there. And further you should be having a holistic approach for the same, that what kind of risk are there. So it's basically related to that the risk may be present at the transaction level, or it could be the risk that is particularly related to present on the portfolio level over there, right? Basically it means what, that some of the risk may be present in the individual loan accounts, and some of the risk may be in basically be imposed on the portfolio level over there. Like let me just give an example. The credit risk is associated with both, that is on the individual level as well as on the particular portfolio level. But if we talk about the concentration risk, if we talk about the concentration risk, the concentration risk is associated with only and only what, it is associated with the portfolio level only. It's associated with the portfolio level only, right? That's the main thing. Now let's have a look at this particular case study so that you can understand the content better, and you'll be having a better understanding. Let's have a look at it. So it says branch B has extended a loan of rupees 1 crore in accordance with the corporate policy, right? So rupees 1 crore loan has been sanctioned, and particularly this loan has been sanctioned for 5 years. So this is a timeline. So this is a timeline. Let me just draw the timeline for you. 0, 1, 2, 3, 4, and 5. So the loan has been sanctioned for 5 years. Let me just draw that the loan will be somewhat like this. This is the red line is basically indicating the loan which has been sanctioned over there. And further, it has been sanctioned for a period of 5 years at the rate of interest 1% over the BPL. So whatsoever the base prime lending rate is there, right? Base prime lending rate is there. Based on that plus 1%, the rate of interest is to be charged on the loan account, and we are considering for now the BPLR to be 10%. So the rate of interest that is being charged on the loan account, that's 11% over there. And further, the loan is to be repaid in equally quarterly installment. Okay, so within particularly quarterly installments, the loan is to be repaid, and they're having the moratorium period of 1 year. So we are basically having this particular moratorium period. The blue line is basically indicating the moratorium period. During the moratorium period, the loan installments are not to be repaid, but the interest will be accrued, right? So that's the main funda, and it's also said to be the interest holiday period, right? Interest holiday period, right? And further, funding of the loan is done from a deposit of 3 years of the same amount. Now we are having the funding from particularly a deposit which is of the same amount. Let's say we are having the deposit which is going to be mature in just 3 years over there. So it's 0, 1, 2, 3, right? That's the main case. So that's the main thing over there. Now funding of the loan is to be done from that particular scenario. Interest rate on the particular deposit rate, that is 6%. So on loan we are going to basically receiving BPLR plus 1%, and on deposit we are paying 6% to the depositor over here. So what are the risks which are associated with the transactions without considering the CRR and SLR requirements? So we are not to consider the CRR SLR requirements, but we need to tell that what type of different risks which will be associated over here, what different type of risks that will be associated over there. So we need to basically comment upon the same, right? So kindly do answer over here at the earliest which type of risk you will find that this must be there in this particular count. Kindly do answer over here. So first of all, the risk would be the funding risk. Just let me test write the different type of risks over there. So first of all, it's the funding risk which will be there. It's basically mentioned we'll be having the funding risk over there. Why funding risk is there? Because after the 3 year period, we basically need to replace the net outflows. After 3 years, this particular deposit amount will be repaid back. We are having rupees 1 crore of the deposit, because after 3 year period the person may take back the deposit over there, and it may be the case that we are not able to procure the same amount of deposit from the market over there, and we'll be having the lesser liquidity with us. And moreover, we have already invested the money into the loan account over there, we have already lent the money. So in that scenario, after 3 years, I will have to basically arrange rupees 1 crore, right? So that will be what kind of risk? That will be the funding risk. First of all, it will be the funding risk which is associated in that particular scenario. And after 3 years, how much amount only I must have received? I must have received only 50% of the amount. Why? Because in this 1 year I have not received any kind of the installments, and in the 4 years I will be receiving the full amount. So in the 2 years I will be receiving half of the amount. So by the end of third year, we must be receiving only 50% of the total amount, because the moratorium period was for particularly 1 year. The moratorium period was for 1 year, and in these 2 years we must have received 50% of the amount if there was no default at all. If there was no default at all, right? So that was the case. And also it may be the case that the time risk may be imposed. Now what is time risk? Now time risk is basically related to, it may be the case the installments which were due were not paid by the borrower in time. If those installments would not have been paid in time, in that scenario, it may be the case that the liability that is standing even at the end of the third year is more than 50%. It may be the case related to it. So the particularly we can say the particular risk, which type of risk? Time risk may also be there, right? The third type of risk that may be there, it's actually related to the basis risk, because we have sanctioned the loan based upon BPLR. BPLR is bench prime lending rate, and that's a benchmark rate that we are using over there. So it's a floating rate we are charging on the loan. It's a floating rate we are charging on the loan, but on deposits we are paying a fixed rate of interest. On deposit we are paying a fixed rate of interest. So when the rate of interest on this particular BPLR, that will be particularly be changed, right? In that scenario, the interest will be changed. Let's say case BPLR reduced. Now, for the first very instance, when the loan just got started, the net interest income would be related to, the net interest income would be equal to 10% plus 1%, that is 11%, minus 6% that we are basically paying on the deposit, that's equal to 5%. Let's say later on the benchmark prime lending rate, that is a BPLR, reduced to 9%. In that scenario, now our net interest income will also be reduced. So if the BPLR is 9%, the net interest income will be equal to 10% minus 6%, that is equal to 4%. So that is also a risk which may be there, that is said to be the basis risk, that is particularly imposed because the different deposits and liabilities are based upon the different types of the benchmarks risk over there, benchmark rates over there. Is that clear? Is that particular part clear over there? And also it could be related to the other risk that may be imposed in this scenario. It may be related to the gap risk. It may be related to gap risk is imposed. Gap risk is also said to be the mismatch risk over there. It is also said to be the mismatch risk. Why the gap risk will be there? Now after the 3-year period, we need to basically fund this loan because the deposit is repaid now. The deposit is repaid to the depositor, and we must be funding this particular loan after this particular 3-year period. And further, it may be the case that the deposit rate of interest may not remain all the same, because previously we have received the deposit at 6%, right? It may be the case that the rate of interest may have now been increased, right? Now in that scenario, that will be the gap risk or the mismatch risk over there. There may be the gap risk and the mismatch risk in this particular scenario that may be imposed for it, right? And also the other type of risk which may be imposed, it could be related to the reinvestment risk. It could be related to the reinvestment risk. Now what do you mean by reinvestment risk? It may be the case, let me just explain this to you. The reinvestment risk, let's say case that you are receiving the EMIs on monthly basis, 1 2 3 4 5, right? Now we basically have procured the deposit and further at 6%, and further have invested the money at 11% over there. That was the scenario. Now, whatsoever the EMIs that we are receiving back, let's say I'm receiving rupees 5,000 of the EMIs, it may be the case that's a repayment that I'm receiving. It may be the case I may not be able to reinvest this 5,000 rupees at 11% out there, because I have previously, invested the money at 11% per annum, but now it may be the case that I may not be able to reinvestment the received money back at the same rate of interest over there. So that can also be an issue. That can also be an issue. So it would be what kind of risk? It will be the reinvestment risk over there. It will be the reinvestment risk. Is that clear? Kindly do confirm, kindly do participate, kindly do confirm at the earliest that is this concept clear to you, because these concepts are very much important so as to understand, and these are the hotcakes in CIIB, right? So you definitely will be able to see the questions related to all these things over there. So that's the main part related to it. So the reinvestment risk will also be there, and also the other risk which will be there, just let me just write over here, it will be the embedded option risk. This particular risk will also be there, embedded option risk. Now what is embedded option risk? Embedded option risk is related to that if the loan is taken by the borrower can prepay the loan. The borrower can make the prepayment, and also the depositor can get the premature withdrawal of the FDR. So that is an embedded option risk associated with the same. So there is an embedded option risk which is associated with the same over there. So what different type of risk we have covered so far? One, it was related to the funding risk. The other one is related to the time risk. The third one it's related to the basis risk. The fourth one it's related to the gap risk. The fifth one it's related to the reinvestment risk. The sixth one related to the embedded option risk. So these all risks are associated with the same. And other than that, it could be the credit risk, that is the default risk, or it may also be the case that the operational risk can be there. It may also be the case that the legal risk is there. Now the legal risk is there when, let's say case, you have sanctioned a loan to the incapacitated party. So in that scenario it will be the legal risk. And further, it can also be the case related to the documentation risk, because if I have not procured particularly momentarily documents, then that scenario the documentation risk can also be there, right? Is that particular case study clear to you guys? Because it was quite an important case study, and I hope that you must have understood the concepts related to the same. So kindly do write yes if you have understood the concept related to the different types of risk over here. So kindly do write yes if I have understood the concept related to the same, right? So let's move further. Let's move further. It's related to risk measurement. The second step, that's the quantification of the risk. That's the quantification of the risk over there, right? Now we basically need to capture the variations in the earnings. Now that's particularly the risk is particularly that how we can quantify the risk over there. That previously I was earning rupees 50,000, now able to earn rupees 48,000. Now the variation of 2,000 is there. Why this variation is there? If I just quantify that why this variation is there, I'll be able to conclude that what amount of risk is there, right? That's the main thing related to it. So we can quantify the risk based upon three approaches. It's a based on sensitivity, based on the volatility, and based on the downside potential. Now, first of all, we'll be starting with the based on sensitivity. Based on sensitivity. So sensitivity is actually related to what? That you are going to capture deviation of the target variable of a target variable. Let's say the case we are looking at the change in the current market value of the bond. You are looking into the change in the value of the current market value of the bond over there. So if you change 1% of the interest, 1% of the interest, that is particularly a parameter that we are considering this particular factor, because sensitivity is actually related to what? When you're moving one parameter only, when you're moving one parameter only and keeping all the parameters fixed, then what will be the change in the particular part over there, or particular target variable over there? That's the main thing. That's the main thing, right? So we are just moving one particular single parameter, unit value of the same is being moved, and that is a particular interest rate we are considering to be the parameter over there. We are considering it to be the parameter over there. And the current market value, we are considering it to be what? We are considering the current market value as the target variable. We are considering the current market value as a target variable. So when we are moving the unit value of the parameter, what will be the change in the target variable? That is particularly said to be what? That is the sensitivity. That is the definition of the sensitivity over there. Now, is it practical? The question is the sensitivity measurement is practical? No, it's not practical at all. And that's the biggest limitation of the same. Because when the market does change, it's not related to only one parameter is going to be changed. The multiple parameters do change and they impact particularly intensively on that particular target variable, right? So that's the limitation related to the sensitivity. That is the limitation related to the sensitivity. And also the sensitivity is particularly measured depend upon the variable particular assumptions that you have made so far, but it's not the case. That's not possible at all. So that's particularly how we can do measure the sensitivity, right? The second one, it's related to the volatility, that how you can measure the variability. That's the volatility. Now volatility, you must be understanding, let's take the case that you are looking at a target variable. We are looking at a target variable, and for the under the different market conditions, you are having a different value of the target variable. We consider the target variable to be R, and under the different conditions, we are having the value as R1, R2, R3, R4, and so on up to Rn. These are the Rn values that we are having for this particular target variable under the different market conditions. Different market conditions, when the different variables does change, or different particular, let's say, parameters does change, in that scenario we'll be having the different value of the target variable over there. Is that clear? Now if we'll be calculating the average of this particular target variable, if we will be calculating the average of this target variable, that can be calculated as R1 plus R2 plus R3 up to Rn divided by the number of terms, that is n. We can calculate a mean of the same or average of the same, that we calculated, right? Now when we'll be drawing this particular average on the graph over here, when we'll be drawing the average on this particular graph over there, in this scenario, if we draw the average value over here, the RA value will be somewhat here. The RA value will be somewhat here. And if we plot the different values of the same, the values will be at the different parts. So let's say we are having the values of the R1, R2, R3. Some of the values will be lying on the left side of the particular average of the random variable, and some of the values will be lying on the right side of the average of the random variable. Is that clear? Is that particular part of clear over there? Now if we draw a graphical expression for the same, it will be something like this. It will be something like this, right? Now this particular graph is indicating the volatility. Now you can basically be looking at the particular factor that I have drawn with the red marker over there. It's the dispersion. It's the dispersion, that how the different values of the random variable are being dispersed. Now you'll be having the positive side also, Now this particular side is indicating the positive side, and this particular side is indicating the negative side. Why I'm saying the positive side and the negative side? Because some of the values, when those are on the right side or the left side, those are positive for you. So let's say if we are considering a target variable in such a manner, if it is particularly increased, it's favorable, and if it is reduced, it is not favorable. In that scenario, we can say one side will be positive and the other side will be negative over there. Now what does it indicate? It indicates that the volatility does consider the positive potential and also as a negative potential. Means it captures the upside potential also. The volatility captures the upside potential also, and also the volatility captures the downside potential, and that's the limitation of the volatility. So using the volatility, we can capture, we can do capture what? We can do capture the variability of the particular variable over there, but it does capture the upside potential as well as the downside potential. But for the measurement of the risk, which side must be captured? Which side must be captured for the measurement of the risk? For the measurement of the risk, we have to capture the downside potential. We are considering just the downside potential over there. We should not be considering the upside potential. So that's why it's a particular, we can say, it's a drawback of the volatility. It's a drawback of the volatility, right? So that's the one particular point you must be understanding. The other one, it's related to, if we look at the volatility mathematically is equal to standard deviation. So if we say standard deviation is volatility. So simply we can say the standard deviation is the volatility. And how come the standard deviation can be calculated? Let me just tell you over here. Let me just tell you that how we can calculate the standard deviation over here, standard deviation formula. So it's basically x1 minus x bar, where x bar is the mean and for the square of the same, then x2 minus x bar for the square, and plus and so on up to x n minus x bar square, and divided by the number of terms, that is n, and under root of the same, and under root of the same. This is the formula related to standard deviation. Now standard deviation is basically indicating the variability of the particular thing. Now variability is particularly the risk associated with the same. So we can simply say more is a standard deviation, more is a standard deviation, more is a risk associated, more is the risk associated. And whensoever we are to consider between the two different zones, let's say we are having a zone A whose standard deviation is equal to 3.5, and you're having the zone B whose standard deviation is 4.5, and further you have to basically check that if the zone A is more riskier or zone B is more riskier. In that scenario, you must be calculating the standard deviation by mean. You are to calculate the standard deviation divided by mean, and further more is this particular factor, more is the risk associated with the same. More would be the risk associated with the same. Is that particular part clear? Kindly do write yes if you're basically clear with this such part over there. These particular things are very much easier to understand with learning sessions only, right? So if you're basically considering this particular lecture helpful, do like this video and do share this video among your friends and colleagues who are preparing for CAIIB, right? And we are going to have all the sessions in English only, and also we'll be starting with the bilingual sessions very soon with for you guys, right? Also the sessions by Banpriya ma'am and are going on. Kundan sir will be starting off very soon in bilingual language over there. But let me just tell you that this particular chapter is very much important from the module B, right? So that's the concept related to the volatility. I hope that this particular concept is clear to you all, right? So after that, it particularly is related to the one particular formula that you need to memorize, and that is actually volatility over the time horizon. Volatility over a time horizon. Let's say case I'm provided with the daily, I'm having a particular portfolio of 60,000 rupees, or let's say 1,60,000 rupees is a portfolio amount, and I'm having the volatility of 2%. I'm having the daily volatility. I'm having the daily volatility of 2%. Now, daily volatility of 2% would be equivalent to what? It will be equivalent to 2% of 1,60,000. That is equivalent to 32,000. That will be equivalent to what? 3,200 or what? So 1,60,000 multiplied by 2%, that is equal to 3,200. That is equal to 3,200. That's the daily volatility. Now let's say that you are to calculate the daily volatility for a time horizon of 10 days. You have to calculate the daily volatility for a time horizon of 10 days. Then how you can be calculating? Daily volatility is equal to 3,200 multiplied by square root of the time horizon, that is under root of 10. And this is how you can be calculating the volatility over a time horizon. Such numerical was already being asked in the previous year exam. So kindly do not forget to learn such kind of concepts also, right? So under root of 10, that is equal to 3.16, and further multiplied by 3200. So the volatility will be equal to 10119. That was particularly volatility for 10 days, right? So we can say volatility for 10 days was equal to this particular amount, right? So this is how basically we can be calculating the things over there and how we can be learning the things. Now after that, it's related to the somewhat question that I just basically made you understand. Now it's actually related to that the operating profits in the 5 different zones were analyzed, right? Basically we analyze the profits from the 5 different zones, right? Now the name of the zone was name 1 A B C D E. These are the different zones over there, and for the different years you are having the operating profits for year 1 2 3 4 5. In particularly these rows we are having the operating profits for different years, right? And we calculated the mean. How come we calculated the mean? I'm just calculating it for the first line. So it is actually equal to 11 plus 9 plus 3 plus 12 plus 11, divide by 5 because there were 5 years, so it is 9.2. That how we calculate it. And if we calculate the standard deviation, how we can calculate the standard deviation? As I just told you, the formula is quite simple. It's particularly the x1 minus 9.2. X1 is particularly 11, so 11 minus 9.2 square of the same, plus second term, that is 9 minus 9.2 square of the same. And as soon as for the third term, that is 3 minus 9.2 and square of the same, and so on, divided by 5, and further under root of the same, further under root of the same. That is how we calculated the standard deviation, and we calculated it to be 3.25. We calculated it to be 3.25, and so on. We calculated for all the regions. In exam you will be particularly given this particular data only. You will be given the data up to this particular point only, not more than that. So this particular data only will be given to you in the exam. Is that clear? So this particular data will only be given to you in the exam over there, not related to the other data. You need to calculate yourself, right? Is that clear? So you basically calculated the mean values, then you calculated the standard deviations, and further from this particular point only, let me just draw this particular point. From this particular point only, you can be inferring some information. Like if they ask you which zone is more riskier, if they ask you which zone is having the particular more riskier, in that particular scenario, what will be the answer? Kindly do answer at the earliest. Which particular zone is more riskier in this scenario? Because the variability is in which zone is the most. Variability in which zone is the most? We are having the most variability here, 5.39. 5.39. This is the most variable zone over there, right? And the particularly if we say after that, so as to get in comparison between the different zones, I told you already, we'll be calculating what factor? We'll be calculating standard deviation divided by the mean factor. Standard deviation by the mean factor that we need to calculate. So whatsoever the mean that we calculated, we need to basically calculate what? We need to basically calculate the factor of the standard deviation divided by mean. Standard deviation divided by the mean factor that we calculated, and for the different zones we calculate these values. Now the zone B is having the highest standard deviation by mean, so it is the most riskiest zone. And if we say which zone is the least riskiest, so it will be zone A, which is least riskier, which will be least riskier. So this is how you can basically be learning that which zone will be riskier and which zone will not be that much riskier. Is that clear? Is this particular part clear to you guys? Right? So next, let's move to the volatility. We need to basically calculate the standard deviation from the mean. We need to calculate the standard deviation from the mean. So the profit for the different particular regions are given. We are having the total over there. And further, we need to calculate the standard deviation from the mean over here. So how we can be calculating? So it's quite simple. So we're already having the total. So what will be the mean? So it is 4980 divided by 5, that is equivalent to 996. So the mean value represented by x bar is equal to 996 over here. It is 996. And how come we can calculate the standard deviation? It's quite easier. So 996 minus 1000, that is equal to minus 4 square, plus 1020, that is the second term, 1020 minus 1020 minus 996, that is equal to 24 square, plus 1040 minus 996, that is equal to 44 square, plus 980 minus 996, that is equal to minus 16 square, and 940 minus 996, that is equal to minus 56 square, and further divided by 5 and under root of all the same, right? So this is how we can be calculating the standard deviation. This is how we can be calculating the standard deviation. So what will be the answer? It will be equal to 16 plus 24 into 24, that is equal to 576. So it is 576 plus 44 into 44, that is equivalent to 1936. And further 16 into 16, that is equal to 256. And further 56 into 56, that is 3136, divided by 5. So we have to basically get a total of the same, that is equal to 3136. 3136 plus 256 plus 1936 plus 576 plus 16 divided by 5, that is equal to 1184, and under root of the same, that is equal to 34.4. So the standard deviation is 34.4 in this scenario. Is that clear? So this is how we can calculate the standard deviation. Okay. So this is how we can calculate the standard deviation. After that, it's related to the topic of the downside potential. It's related to topic of the downside potential. As I already conveyed the idea to you, in case of volatility, what was a particular drawback? In case of volatility, what was a major drawback? That you were calculating, only the, you were calculating both upside potential as well as the downside potential. But we are basically focusing on what? We are just to focus on the downside potential and not on the upside potential over this. So we are not to calculate the upside potential for the same. And further, that's why the downside potential is the ultimate approach so as to quantify the risk factor over there. So as to quantify the risk factor over there. Now, in a basic problem with the downside potential calculation is that we have to consider two factors. We have to consider two factors. First of all, it's related to the first factor. It's actually related to what? It's related to the potential losses, that we need to calculate the potential losses. Whatsoever the potential losses can be there, we need to calculate. Now it's easier to calculate the potential losses, but the probability of occurrence is difficult to calculate. That's the second factor. So the first factor is potential losses. The second factor is related to probability of occurrence, estimating the probability of occurrence. Now that's quite difficult to calculate. Now that's quite difficult to calculate the probability of occurrence over here. Is that clear? Okay. So the major problem that downside potential, we consider VAR the most important point so as to calculate the downside potential. VAR is a sophisticated modeling technique that is a value at risk. VAR means what? This is value at a risk, which is quite important, over here. Is that clear? Now, value at risk particularly comes with the particular confidence level. Let's say it says value at risk is rupees 8600, at 99% confidence limit. That is, a confidence limit is given to be 99%. And further, it also is given for a particular time horizon. Like a value at risk for 1 day may be different from value at risk for the 2 days, right? So let's say it is particularly given to be 30 days. That for 30 days period under the normal conditions, because that's the main part related to value at risk, that value at risk is actually calculated for the normal conditions. It is particularly valid only for the normal conditions. Only valid for the normal conditions, right? So the value at risk, under the normal conditions will be related to saying what? It will be saying that the maximum loss under the normal conditions will be up to rupees 8600 with 99% probability. 99% probability means in 99% of the cases, the maximum loss under the normal conditions will be limited maximum to rupees 8600. And further, there are only 1% chances, only 1% chances that it will be beyond 8600, that it will be beyond 8600 over a time horizon of 30 days. Is that clear? Is this particular part clear over here? Now let me just quote another example to you. Let me just quote another example to you. So if I say that the value at risk, if I say that the value at risk is particularly given to be, it is particularly given to be 10,000. It is given to be 10,000 with 95% probability for 10 days horizon. For 10 days horizon, what it will be indicating? It will be indicating under the normal conditions. First of all, under the normal conditions, the maximum loss in 95% of the cases will be limited up to rupees 10,000 only, and just the 5% cases under the normal conditions will be there when your loss can be greater than 10,000 for the time horizon, for the 10 days time horizon. So that is what we basically want to convey from this idea. Is that clear? Kindly do confirm the same. Kindly do confirm the same if this particular point is clear to you. Okay. So that was actually related to the particularly downside potential and all the things over here. I hope that this particular chapter is clear to you so far. And the in another part of the same chapter, we'll be covering the risk pricing and all the other things over there. And also we'll be starting with the second unit of the module B. So stay tuned for the upcoming sessions. And let me tell you, just if you want to get the PDF of this particular session, in that scenario, you need to WhatsApp us. You need to WhatsApp us writing CAIIB. You have to write CAIIB, and further you need to WhatsApp it to the number 83609 83609 44207, and further our team will be adding you to the WhatsApp group where you will be getting the PDF files and the case studies and everything over there. So do WhatsApp us right now and further start preparing for the same. The next session will be tomorrow morning at 6:45 a.m. So stay tuned for the same. And further, the sessions will be available just for 24 hours. So do not miss the sessions at all. And further, we'll be preparing each and every bit for the CIB. So that will be all. Thank you so much and see you again in the next video tomorrow.